Hello everyone, welcome to my channel. I'm Dr. Q. In this video, we will discuss the importance of recognizing the time value of money. Managers also need to make decisions about short-run and long-run strategies. Now, the importance of the time value of money matters. What's the meaning of the time value of money? Here's some intuition. If I borrow you $100 today and propose to pay you back, does it matter to you if I return the $100 tomorrow or in 10 years? I bet it matters to you because of the opportunity cost. If you did not lend the $100 to me, you could have deposited to a bank account, and in 10 years, probably will earn you about $50. If you buy stocks or Bitcoin, the yield is probably much higher. If you didn't deposit, you spend the money because of inflation. $100 today probably gets you more stuff than $100 gets you in 10 years. Now, here's the formula for calculating the present value of a single future value. So it can help tell us to understand if you will get $100 in 10 years, how much money is worth today. That's the meaning of the present value of a single future value. The amount that would have to be invested today at the prevailing interest rate to generate a given future value. Present value reflects the difference between the future value and the opportunity cost of waiting. Here's an example. If a person says that he will return $100 in 10 years, how much money should you lend him today? Assuming the annual interest rate is a constant of 7% every year. The present value is calculated as $100 as numerator divided by the denominator. The parentheses got 1 plus 0.07 at 7%. The whole thing to the power of 10 means 10 years. So the denominator is approximately 1.9672, and the ratio between the two of them give us about $50.83. Alternatively, if you invest $50.83 today at a rate of 7% of interest rate, in 10 years your invest would be worth $100. So the higher the interest rate is, the lower the present value. If interest rate is lower, like near zero, then present value is equal to the future value. Now, what about calculating the present value of a stream of future values? So, for example, in year one, the return is $10,000. And in year two, the return is $50,000. And in year three, the return is $100,000. So as opposed to have a one single future value or return, it has a stream of future returns. How to calculate the present value of the next 3 years' return? It is calculated as the future value of year 1 divided by 1 plus interest rate to the power of 1 plus the future value of year 2 divided by 1 plus the interest rate to the power of 2, and so on and so forth. It can be as many years n as the return lasts. So here's the mathematical way of writing the same thing. So we're assuming the starting from 1 year in future, 2 years, 3 years, t can be equal to any number positive integer up to n, as long n means the year the return lasts to, the last one. And you sum up all of those future value, divide by 1 plus the interest rate to the power of the corresponding year. Now here's an example. A stream of income. Year 1, you got income 10,000. Year 2, 50. Year 3, $100,000. And annual interest rate is 3%. What is the present value of this income stream? Please pause and try to figure out yourself and come back for the answer. All right, this is the answer to this question. The present value is about $148,000, $352.70. Now, but remember, you need to invest now to get the return in future. Therefore, the present value of all future returns minus the current cost, 0 means current or now, of the project is the pure return or net present value. As a manager, if you have to make a decision of a certain project, you can say yes to that project if the net present value of the project is positive, and you have to veto it if the net present value is negative. Here's a practice. Please pause and figure it out. All right, here's the solution to the question. So 1 plus 7% 0.07 to the power of 1, 1 plus 0.07 to the power of 2, and so on and so forth. The numerator is corresponding years of return. The present value is this number. And we can say this is 282,000, more than $282,000 is bigger than the current cost, $200,000, which means present value of future returns is bigger than costs. So the answer is yes. the manager should allow the purchase of the machine. Now, what if the asset can generate indefinite periods of cash flows? Then it is equal to the cash flow generated in the current years plus cash flows generated in year 1 divided by the 1 plus interest rate to the power of 1 plus the cash flow of second year divided by 1 plus interest rate to the power of 2 and so on and so forth. That's the present value of all cash flows, including current and future. If the same amount of cash flow is generated every year, which means now the return is $100,000, next year $100,000, third year $100,000, it's $100,000 every single year and never change. If that's the case, then the present value of all cash flow is the cash flow of any number of any year divided by the prevailing interest rate. As a manager, the fundamental job is to maximize the value of the firm, which is the present value of current and future profits. Here's a formula for calculating the value of a firm with the current profits of pi 0. Current profits pi 0. And assuming there's no dividends paid out and expected. What's the meaning of no dividends paid out? It means no profit is split among shareholders. And the constant profit growth rate of G, and it is smaller than the interest rate, I. So every year, the profit will grow by a constant rate. Then the firm's value, present value of the firm is equal to the current profit plus next year's profit, which is current year profit multiply 1 plus G as it's growing by G percent. So, and then divide by the 1 plus I to the power of 1, the present value. And the second year will be the same pi 0 grew for 2 years to the power of 2 and divide by 1 plus interest rate to the power of 2 and so on and so forth. And if you simplify it, it is equal to pi 0 plus multiply the parentheses, numerator is 1 plus interest rate, denominator is interest rate minus growth rate. As interest rate is bigger than growth rate, this whole thing is positive. But if when the dividends are immediately paid out to current profits, then the present value of the firm is the present value of firm minus the current dividends paid out. And so it is equal to this value minus pi 0. And you move pi 0 out of the parentheses, and this parenthesis minus 1, you'll be able to figure out is this one. Pi 0, you multiply the numerator 1 plus growth rate divided by the numerator interest rate minus growth rate. Now, how do we balance the short-term profits and the long-term profits? Actually, if the growth rate in profits is less than the interest rate and both are constant, maximizing the current or short-term profits is the same as maximizing the long-term profits. All right, that's all we're going to discuss about the present value of profits. Thank you for watching the video. Please subscribe to the channel and see you in the next one.